So, not too long ago, Bitcoin just fell off a cliff. We're talking a sudden, gut wrenching $10,000 plunge. Now, of course, the headline screamed panic selling. But you know what? The real story here wasn't about human emotion at all. It was about a machine. And we're going to break down exactly what happened. Yeah, it all kicked off with this really baffling question. I mean, the markets just went into a total tailspin. But the weird part, it wasn't just one market. We saw Bitcoin, big tech stocks, and even gold, the classic safe haven asset, all take a nosedive, all at the same time. So what on earth could possibly connect these completely different assets? I mean, this event sent absolute shockwaves through the financial world. It just felt like pure chaos, a sudden, widespread panic where it seemed like investors were just selling everything that wasn't nailed down. You could almost feel the confusion in the air. And just look at these numbers. They were absolutely brutal. Bitcoin, it shed nearly $10,000 in value. Microsoft, a giant of the tech world, dropped 12% right after its earnings report. Gold lost 11%. Silver, it plummeted by a staggering 30%. The entire NASDAQ got dragged down with them. See, this wasn't just a crypto problem or a stock problem. This was an everything problem. So naturally, the media immediately started pointing to all the usual suspects. But, while those headlines gave everyone some easy answers, they were completely missing the real story. The real story was happening deep inside the hidden plumbing of the financial system. You saw it all over the place, right? Headlines screaming about a bursting AI bubble, a hawkish Fed nominee named Kevin Warsh, rising tensions in the Middle East, all the general worries about inflation. And look, while all those things definitely created a sense of unease, they weren't the actual trigger. The real cause wasn't human fear. It was something far more mechanical. The truth is, this whole crash wasn't really driven by human emotion. Not really. It was driven by automated, interconnected financial systems. Think of it like the hidden plumbing of the modern markets. So, no, it wasn't a panic. It was a machine, simply executing its programming. Okay, now this is where it gets really interesting. This is basically the smoking gun. What you're looking at is a chart from a Bloomberg terminal, and it shows the price of a major tech ETF and BlackRock's Bitcoin ETF on February 5th. Just look at that correlation. They move in almost perfect, kind of eerie synchronization. This is no coincidence, folks. This is proof of a mechanical link. So how in the world are they linked? Well, it all starts with a strategy called basis trading. This is a huge favorite of hedge funds. Here's how it works. They buy an asset like Bitcoin on the spot market, and at the exact same time, they sell a futures contract for it. They're not betting on the price going up or down. Nope, they're just trying to collect that small, pretty low-risk premium that exists between those two prices. And right here, this is the crucial piece of the puzzle. This is what connects that basis trade to everything else. It's called cross-margin collateral. So instead of putting up separate collateral for every single trade, hedge funds just pool it all together. We're talking tech stocks, gold, their Bitcoin positions, everything, into one giant account. It's super efficient for them, sure, but it creates this massive underlying systemic risk. Okay, so here's exactly how the whole machine kicked into gear. First, an event happens. Let's say tech stocks fall, which creates losses in a hedge fund's portfolio. That's the trigger. Instantly, their automated risk management systems go off, demanding they reduce risk and raise cash, like right now. And here's the kicker. Because of that cross-margin system we just talked about, the system doesn't just sell the losing tech stocks. No, it sells a little bit of everything in that collateral pool. And what's the most liquid, 24/7 asset they can sell for instant cash? You guessed it, Bitcoin. It's basically their round-the-clock ATM. So you see, this whole thing wasn't just another market crash. It was a signal. It was a huge flare in the sky, revealing a fundamental shift in how the Bitcoin market actually operates now. The old rules, they might not even apply anymore. We are in a completely new era. For years and years, Bitcoin's price was pretty much dictated by what we call the halving cycle. It was this predictable supply shock every 4 years that fueled these insane retail-driven rallies, followed by these brutal 80+% crashes. Well, that era, it's over. Now we're in what you could call a flow cycle, and it's completely dominated by institutional demand, mainly from these new ETFs. And what does that mean? Well, for one, volatility is actually lower, and the key players, they're no longer just us regular folks. They are massive, massive funds. And if you really want to wrap your head around the power of this new flow cycle, just look at this stat. The demand for Bitcoin coming from ETFs every single day can be 12 times greater than all the new supply being created by miners. I mean, that old supply side driver that we all used to watch, it has been completely and utterly dwarfed. All right, so what does this all mean for us, right? How are we supposed to navigate this new institution-driven reality where Bitcoin is basically connected at the hip to everything else? Well, the answer might actually come from a pretty unexpected place. It's a cool fact from nature. When a storm approaches, cattle will turn and run away from it, which actually ends up prolonging how long they're stuck in the bad weather. But bison, they do the exact opposite. They turn and charge directly into the storm. They just know instinctively that the fastest way to get to the other side is to go straight through it. So, what does it mean for us to be the bison in this market? It means that while all this automated selling creates a massive storm on the price charts, we can choose to look past that noise. And we can do that by looking at on-chain data, which measures the fundamental health of the Bitcoin network itself. And right now, it's telling a very, very different story. Okay, let's take one example, the MV/RV ratio. It's a really neat tool that basically compares Bitcoin's current market price to the average price that investors actually paid for their coins. And as of right now, that ratio has fallen all the way to minus 29%. Now, why does that matter? Because historically, a drop this significant has almost always signaled a zone of maximum opportunity. In other words, a potential market bottom. And here's another one. Look at the percentage of the total Bitcoin supply that's being held at a profit. It's dropped to just 55%. Now, what that tells us is that we're getting close to a point of maximum pain, where nearly half of all holders are underwater on their investment. And in every single previous cycle, this exact moment of capitulation, this giving up point, has been the direct precursor to a powerful, powerful recovery. So yeah, while this new institutional plumbing can absolutely cause these terrifying, synchronized storms across the market, the underlying on-chain data is suggesting fundamental strength. So the real question isn't whether we should run from this new kind of volatility, but rather, how do we face it? Because just like the bison knows, sometimes the fastest way out of the storm is to charge straight through it.